Now to kind of shift gears again, we're going to talk about the yield curve. Okay, yield curve dynamics, interest rate determination, and asset prices. Okay, and then we're going to get into cost of capital, discounted cash flows, and investment decision making. But again, you can't get to investment decision making until you understand yield curve dynamics. Because all debt, all equity, securities, all asset prices are priced off the yield curve. It's the number one systemic and systematic factor that drives asset prices up and down. The yield curve is a path of interest rates by maturity. And when we talk about the yield curve, we're mostly talking about treasury yields, U.S. government bonds, U.S. government notes that are considered risk-free. They do not have sovereign default risk premiums associated with them because the Federal Reserve can always print money to pay the coupon and pay back the principal to the bondholders. So they're considered default-free or riskless or risk-free. Okay? Interest rates, nominal interest rates. Okay, and here's the yield curve here. These are the nominal interest rates. These are the yield. These are the maturities. The interest rates are also called the yield to maturities. So there's an interest rate and a yield to maturity associated with each maturity of the bond. A 1-year bond, a 10-year bond, a 20-year bond. There's an interest rate associated with it. So interest rates nominal, interest rates move up and down by movements in either the real rate or inflation expectations. This is the Fisher equation. This is basically interest rate determination. Nominal interest rates, risk-free rates, move up and down by movements in the real rate and inflation expectations. Real rates do not move on a day-to-day basis. They are basically structural and cyclical, so they move very slowly. So theoretically, they're a constant. So the movement in interest rates and bond prices come mainly from movements in inflation expectations. Okay? Not inflation, inflation expectations, or the expectation of inflation. But the terminology is inflation expectations. Since real rates are relatively stable, interest rate movements are driven by movements in inflation expectations. The Federal Reserve Bank, or the Fed, influences movements in interest rates, particularly short-term interest rates. The Fed conducts open market operations where they move in and they buy and sell bonds in the open market to drive bond prices up and down, interest rates up and down, to regulate the cost of capital up and down to either slow or stimulate the economy over the business cycle. So the Fed can go in through the New York Fed, which is the Federal Reserve Bank that conducts open market operations, and they can buy bonds, driving up bond prices and driving down interest rates, reducing the cost of debt and equity in the process, stimulating the economy, and this is also called monetary policy accommodation. The Federal Reserve can also sell bonds in the marketplace, driving bond prices down, driving interest rates up. In the process, raising the cost of capital, both debt and equity, constricting or restricting the ability of the economy to grow, and also limiting and restricting and pulling back on liquidity in the marketplace. And really the availability of credit and the availability of liquidity is a major factor in driving asset prices. So the yield curve itself, again, is normally upward sloping because of the inflation expectations component. Investors want to be compensated for the deterioration in the purchasing power by buying that bond. So they tack on what is called an inflation risk premium onto the real rate because they want to be compensated for the deterioration in the purchasing power of their bond. So borrowers, governments, and corporations are the borrowers. They're the ones issuing the bonds. They get the money, they're going to invest it, so they're borrowers. Corporations and government like to borrow on the short end of the yield curve. It's also called the term structure. This is also called the term structure of interest rates. I'm not going to get into the math of the term structure of interest rates, but the theory basically states that the yield curve is a geometric average of interest rates. So short-term interest rates predict long-term interest rates. So short-term interest rates and long-term interest rates are related to each other geometrically. So they like to borrow on the short end because it's cheaper, right? The cost of capital is cheaper, so there's an incentive to borrow short and to invest long, although that is problematic. Lenders and investors also like to buy in the short-term bonds because they like the safety and they like the liquidity. But there are investors, lenders, there are borrowers, issuers, that also like to issue and borrow in the medium term and the long term to be able to match their assets, the asset life. So what you find is that on the long term, or the long end of the term structure, or the long end of the curve, these are all terminologies. What you have to understand is since the short-term maturities have shorter compounding periods, I mean, you're using the same discounted cash flow model for bonds as you do for stocks or a firm. Well, if it's a 2-year bond and the interest is paid annually, and I'm going to receive my principal back at the end of the second year, I only have 2 compounding periods. But if I have a 30-year bond, I have 30 compounding periods. Because of the more compounding periods you have, the more sensitive the bond is to movements in interest rates. So the interest rate movement will magnify and impact the price change of the bond. So long-dated, medium-term, and long-dated bonds are more sensitive to interest rates, and their bond prices are more volatile because of all the compounding periods. So just remember that long-dated bonds prices are more sensitive to movements in interest rates. Okay, so let's